So what if I told you that according to the absolute brightest minds in like academic finance, all that time you spend researching companies and reading price charts is basically just mathematically meaningless?
I mean, that's definitely a bold claim to start with.
Right, but that's what they say, that trying to get an edge in the market is just a total delusion, and that your success or failure is really no different than, just flipping a coin in some giant randomized casino.
Yeah, it is a incredibly sobering thought, and it honestly forms the entire bedrock of modern financial theory. But, well, the problem is it completely ignores this really rare breed of individuals who have proven, over decades, that they can generate returns that are so astronomical they just completely defy all statistical probability.
Exactly. So if you are, say, trying to get a leg up in your career, or you're navigating your own investments, or you just want to understand the hidden gears of how elite performers operate under extreme pressure, today's deep dive is going to totally force you to rethink how you view risk.
Because we have some truly amazing source material to go through today.
We really do. We are staring down an incredible stack of material today. Specifically, we're looking at excerpts from Jack D Schwager's legendary book, Market Wizards. And our mission here is to uncover the hidden mechanics of how these super traders actually do what they do.
Which is fascinating because, as we'll see, it is rarely about just having better numbers or smarter math.
Right. It's about psychology. It's about ruthless risk management and, unfortunately, learning things the absolute hardest way possible. Okay, let's unpack this. Let's start with this massive academic roadblock that claims beating the market is just impossible.
Right, you're talking about the efficient market hypothesis, or EMH.
Yeah, EMH. The core premise here is just that prices perfectly reflect all known information at any given time, right?
Precisely. The EMH essentially argues that the market is this omniscient, flawlessly rational pricing machine. And academia actually breaks this down into 3 distinct levels of efficiency.
Okay, lay them out for me.
So the first is weak efficiency. This claims that looking at historical price data or, chart patterns is just a total waste of time. The idea is that the market has already priced in whatever happened yesterday, so technical analysis literally gives you zero predictive edge.
Okay, I can kind of understand the skepticism around reading charts. I mean, it can sometimes look a bit like reading tea leaves, right?
Sure, yeah.
But what if I do the hard work? Like, what if I'm not looking at past prices, but I'm actually studying a company's quarterly earnings or reading crop reports, looking at supply chains? Surely I have some kind of edge over someone who just isn't doing that fundamental research.
Well, according to the academics, you don't. And that brings us to the semi-strong version of the EMH.
Which means what exactly?
This one argues that all publicly available information is just instantly absorbed and priced into the market the very second it's released. So by the time you've, sat down and read that crop report, thousands of computers and major institutions have already traded on it. You are basically always too late.
Wow. Okay, so that's weak and semi-strong. What's the last one?
The last one is strong efficiency. And this takes it to the absolute extreme. It claims that even private, insider information won't give you an edge.
Wait, really? How does that even make sense?
The theory is that the market somehow intuitively sniffs out and prices in that secret knowledge immediately based on the aggregate actions of everyone involved.
I mean, I just have to push back on this entire framework. And the EMH fundamentally assumes that just because everyone has the same information, everyone's going to process it the exact same way and then make the exact same perfectly rational decisions.
Which we know isn't how humans operate.
Exactly. And Schwager uses this brilliant analogy about chess to completely dismantle this. Just think about a high-level chess tournament. Every single player sitting there knows the exact same rules, right?
Where the information is entirely public.
Yeah, the board is fully visible. There is literally no hidden information. They all have access to the exact same historical records of past Grandmaster games. So the information distribution is completely equal and perfectly efficient. Yet only a tiny handful of players consistently win the championships.
That's a really great point. Why is that?
Because they exploit the psychological blind spots of their opponents.
Yeah.
They prey on the fatigue and the miscalculations of the players who are looking at the exact same board.
Yeah.
So if markets are supposedly perfectly rational, how do we explain the absolute irrationality of human behavior?
What's fascinating here is that human emotion is the glaring vulnerability in the efficient market hypothesis. The whole theory basically assumes traders act like these emotionless algorithms.
Which they obviously don't.
Right. In reality, when humans trade, fear and greed completely warp that perfectly distributed information. When greed takes over, the crowd collectively just ignores risk. They drive prices violently above any kind of rational valuation.
Which is exactly what we call bubbles, right?
Exactly. And on the flip side, when panic sets in, sheer terror drives prices irrationally low. These emotional extremes create severe mispricing. The market wizards don't beat the market because they somehow have better or faster information.
Right.
They beat it because they ruthlessly exploit the emotional mispricing that's created by everyone else's panic or greed.
But spotting the irrationality is only half the battle, right?
Yeah.
Surviving it is another thing entirely.
Yeah.
And Schwager brings up this terrifying reality check from the 1999 tech bubble.
Oh, yeah. This is a classic example.
Imagine you are this deeply analytical, totally rational trader in late 1999. You're looking at the NASDAQ hitting 3,000. You look at the fundamental data of these .com companies that literally have zero revenue, and you correctly conclude, this is absurd. It's a massive bubble.
A completely sound and rational conclusion.
Right. So you act rationally. You bet against the market by shorting it.
And if we just look at the long-term timeline, your analysis would have been totally flawless. I mean, over the next decade, the NASDAQ spent most of its time trading between roughly 1,100 and 2,900. Your assessment of fair value was completely correct.
However, our smart, perfectly rational trader who shorted at 3,000 would have been, carried out on a stretcher.
Because the market wasn't done being irrational yet.
Exactly. Before the market finally crashed, it actually surged another 68%. It peaked at 5,048 in March of 2000.
Which just highlights the ultimate paradox of trading. You were 100% right about the valuation, but you went bankrupt anyway, because the market can just remain irrational far longer than you can remain solvent.
Yeah, and if we need actual mathematical proof that the EMH is flawed, we just have to look at market crashes. Look at October 19th, 1987. The S&P futures dropped 29% in a single trading session.
Right, and academics always use these standard deviation bell curves to model market probability. Under the EMH, a perfectly rational market does not just drop 29% in a few hours without some catastrophic, world-ending news event.
And there was no world-ending news that day.
Exactly. The mathematical probability of that crash happening in their perfectly efficient market is 10 to the negative 160th power.
Which is just a number so infinitesimally small it practically breaks the human brain. How do you even visualize that?
To put it in context, the odds of a 29% daily drop happening in their theoretical world are roughly equivalent to you randomly picking one specific atom out of the entire observable universe.
Okay, picking one atom.
And then blindly reaching back in and randomly picking that exact same atom a second time.
Oh, wow. So it's basically a statistical impossibility.
Completely impossible, yet it happened. Which tells us the underlying theory of a perfectly rational market is just structurally broken.
So the market is flawed, and it can be beaten. But clearly, as we saw with the .com example, just being right isn't enough. Schwager compares market success to running a marathon.
I love this analogy.
Yeah, it really makes sense. Practically anyone with a pair of shoes can finish a 26.2-mile marathon if they just put in enough grueling training and sheer willpower. But running an elite 2-hour and 15-minute marathon...
You can't just willpower your way to that kind of time.
Exactly. You cannot just outwork your way to that time. That requires a genuine, innate physiological gift. Becoming a super trader is very similar. Competence takes hard work, but elite, market wizard-level performance requires a kind of inner radar for risk.
And if we actually accept that these elite performers exist and that they capitalize on this emotional mispricing, we really have to examine where they choose to operate. Okay. Because the majority of the wizards in Schwager's book aren't just logging into a normal brokerage app to buy, index funds or blue chip stocks.
Right. They play in a much faster, highly specialized arena, the futures market.
Which is a term that immediately intimidates a lot of people.
Oh, absolutely. When people hear futures, they usually just picture that chaotic scene in the movie Trading Places with all the guys screaming in a pit over frozen concentrated orange juice.
Right, waving paper around.
Yeah, but at its core, a future is simply a standardized contract to buy or sell a specific commodity or financial instrument at a specific price on a specific future date. The source material actually gives a really grounding example of a commercial hedger to explain this.
The auto manufacturer example, right?
Imagine an auto manufacturer. They need massive amounts of copper to build their cars. If their analysts are totally terrified that copper prices are going to skyrocket in 6 months, which would destroy their profit margins, they can buy copper futures right now.
So that basically locks in today's price.
Exactly. If copper prices do explode, The profit they make on their futures contract perfectly offsets the higher cost of the physical copper they now have to go buy.
Right, and the automaker is using futures purely to neutralize risk. But the market wizards are entirely different animals. They are speculators.
They aren't trying to build cars.
No, they have absolutely no intention of ever taking physical delivery of thousands of pounds of copper. They are there strictly to profit from the price volatility itself. And they flock to the futures market because of its unique structural advantages.
Like what?
Immense liquidity, incredibly low transaction costs, and most importantly, the mechanics of shorting and leverage.
I really want to highlight the shorting aspect because this is a massive tactical advantage for them. In the regular stock market, if you want to bet against a company to short it, it is a remarkably clunky process.
It really is. It's full of friction.
Yeah, you have to locate shares to borrow from your broker. You might have to pay exorbitant borrow fees if the stock is hard to find. And traditionally, you have to wait for an uptick in the stock's price before you can legally initiate the short trade. But the futures market completely eliminates this friction.
Because a future is just a contract between two parties. There is nothing physical to actually borrow.
Exactly. You want to bet against gold or the yen or the S&P 500. You just sell the contract, boom, done. Equal ease, whether you want to go long or short.
It creates this perfectly symmetrical battlefield. But the most explosive draw to the futures market, and honestly, the reason it destroys so many amateurs, is the leverage.
Oh, the leverage is insane.
Yeah. When you trade stocks, you pay the full price of the share. In futures, your initial margin requirement is usually only 5 to 10% of the total contract's value.
And we really need to clarify what margin means in this context because it is fundamentally different from the stock market. In equities, buying on margin means you are taking out a high-interest loan from your broker to pay for part of the stock.
Right. But in futures, margin is not a loan payment. That is a critical distinction for you to understand. Because you are agreeing to a future delivery date, no physical transaction is actually taking place today.
So what is that 5 to 10% actually doing?
That margin is actually just a good faith performance bond. It is a deposit to prove to the exchange that you have enough capital to cover any potential daily losses. And this brings up a crucial realization. Leverage is just a wildly aggressive double-edged sword.
How so? Give me an example.
Well, if you put down 5% of the contract value as a deposit and the price of that commodity moves just 5% in your favor, you have just realized a 100% return on your capital. You literally doubled your money.
Wow. But if it moves 5% against you, your entire account is vaporized.
Instantly.
Which perfectly explains why futures have this terrifying reputation. The underlying asset itself, like corn or treasury bonds, isn't necessarily wildly volatile on a day-to-day basis.
Yeah.
The danger is that 20-to-1 leverage magnifying a tiny price ripple into a huge tidal wave that could just wipe you out entirely.
And that extreme leverage exacts an incredible psychological toll. The pressure of knowing a minor fluctuation can bankrupt you forces traders to confront their own emotional discipline. Even Jack Schwager, the guy actually interviewing these wizards, had to run this gauntlet and learn these lessons the hard way.
Oh man, his early career is just a masterclass in the absolute chaos of unchecked confidence.
It really is.
So it's the 1970s, and Schwager is working as a fundamental commodity research analyst at a major brokerage. Ironically, his department strictly forbids analysts from actually trading the markets they cover.
Which, makes sense for compliance.
Right. But he is so convinced of his own economic forecasting abilities that he has his brother open a secret $2,000 account for him. And the logistics of how he trades this are straight out of a comedy.
I mean, he obviously can't call a broker from his own desk.
No. So he is constantly sneaking away, taking the elevator down to the building's basement, and pumping coins into a public payphone just to place these highly leveraged trades.
The paranoia must have been immense. He even developed an elaborate system of weather codes to communicate with his broker because his office had a glass partition.
Oh my gosh, the weather code.
Yeah, if someone was walking by, he couldn't be caught yelling about buying silver. So if he needed to execute a buy order, he would look out the window and say loudly into the phone, "The sun is out."
That is so funny. And if he needed to sell,
he'd say, "The weather is cloudy."
It's hilarious to picture, but the stakes were very real. And the trade that ultimately broke him was his disastrous cotton play. So Schwager performs this deeply rigorous fundamental analysis of the cotton market. Cotton is currently trading at 25 cents a pound. His data tells him it will rise, but it will absolutely hit a fundamental ceiling around 32 to 73 cents.
So he has his thesis.
Right. And at first, he looks like a total visionary. Cotton edges up. Then it aggressively jumps from 28 cents to 31 cents in a single week. Schwager looks at his research, decides 31 cents is close enough to his projected top, and he goes short. He bets heavily that the price will collapse.
And initially, the market totally validates his ego. The price breaks back down to 29 cents. He feels like an absolute genius. The market is conforming perfectly to his brilliant economic models.
But then, the market just stops caring about his models. Cotton turns around. It rebounds to 32 cents, then 33, 34, 35 cents.
Oh, no.
Yeah, and because he is highly leveraged, every single penny it goes up is just bleeding his account dry. He starts getting margin calls. Eventually, his entire account equity is wiped out, and his broker literally forces him to liquidate his position at a total loss.
He was completely devastated.
He was, but here's the ultimate irony of that trade. He was actually lucky he got wiped out when he did, because that cotton market didn't stop. It eventually soared to an unbelievable 99 cents a pound, which was more than double the highest price recorded in the entire century.
Wow. If we connect this to the bigger picture, the cotton disaster exposed a massive flaw in Schwager's entire worldview. Shortly after that blowout, he met a colleague named Steve Kronowitz, who was a strictly technical analyst.
So he didn't care about the fundamentals at all.
Exactly. Steve didn't care about supply chains or crop reports. He only analyzed price charts, volume, and momentum. Schwager, the fundamental purist, had this massive revelation. Fundamental analysis might be fantastic at predicting what should happen economically in the long run, but it is completely useless for timing.
And when you're trading with 20-to-1 leverage, timing is everything.
Right. The market can act irrationally far longer than your tiny margin deposit can survive. He realized he desperately needed technical analysis to tell him when it was actually safe to enter and exit.
Which leads directly to what Schwager considers the absolute best trade of his early career. And amazingly, his best trade was actually a loss.
That sounds counterintuitive. How was a loss his best trade?
Well, he went long on the Deutschmark, betting it would rise because he saw a strong technical price base forming. But this time, he did something entirely different. Before he even placed the buy order, he established a strict non-negotiable stop-loss order just below the recent price low.
So he mathematically defined his absolute maximum acceptable risk before he allowed himself to even enter the battlefield.
Exactly. And that single act of discipline saved him. A few days later, the market unexpectedly dipped, triggered his stop loss, and he took a minor, entirely controlled loss. But right after he was stopped out, the Deutschmark plummeted like a stone.
In his basement payphone days, that drop would have financially ruined him again.
Oh, completely. This time, because he managed his risk before the emotion of the trade took over, he survived. For anyone listening, whether you are managing leveraged futures or honestly just navigating a complex corporate project, defining your maximum acceptable risk before you execute is the exact dividing line between a professional and a gambler.
Survival definitely has to be step one. But if Schwager's journey from arrogance to risk management is a roller coaster, we really have to talk about Michael Marcus.
Yes, Marcus's story is incredible.
Because Marcus eventually became one of the most legendary wizards at Commodities Corporation, where over a 10-year period, he multiplied his company account by an astonishing 2,500-fold.
2,500 times his money. That is absurd.
It is. But his origin story is proof that even the greatest financial minds begin by making staggeringly terrible decisions. Marcus's background did not scream street smart trader. He was a highly intellectual Phi Beta Kappa scholar at Johns Hopkins, holding a fellowship in psychology.
He was entirely primed for a quiet life in academia.
Right. And then he met a college junior named John.
This part of the source material is pure gold to me. John casually claims he can magically double Marcus's money every 2 weeks. And Marcus, who is just completely naive to the realities of the market, doesn't even interrogate the strategy. He just hires this college kid to be his commodity trading advisor.
What a wild decision. And the compensation package is just...
The compensation package.
Yeah.
Marcus pays John $30 a week plus a daily diet of free potato chips and diet soda.
Just an incredibly low barrier to entry for a financial advisor.
So they head to the Reynolds Securities office in Baltimore. Marcus is wearing his only nice suit, clutching his entire life savings of $1,000. They hear a voice on the brokerage loudspeaker recommending a purchase of soybean meal.
Okay, an actual tip.
Yeah. So Marcus looks at his chip-eating advisor, expecting some brilliant tactical breakdown, and John just looks back at him with a blank stare and asks, "Do you think we should do it?"
That is the exact moment you realize you have handed your financial destiny to someone who's entirely guessing.
Right. But they blindly buy the soybean meal anyway.
Yeah.
And almost mystically, the very second their order fills, the price ticks down. They instantly lose $100.
That's a quick 10% of his net worth.
Yeah. So they panic, sell, and try corn. Same exact result. Eventually, Marcus's $1,000 is whittled down to $500. Feeling the pressure, John pitches a can't-lose strategy. A pork belly spread.
Oh no, a spread.
They're going to buy August pork bellies and simultaneously sell February pork bellies to exploit a price gap. John is so confident in this complex maneuver that for the first time all day, they actually leave the brokerage, quote, board to go out to a diner for lunch.
In leveraged trading, walking away from an unmonitored position is the ultimate kiss of death.
They return from lunch to find the account entirely wiped out. John marches up to the quote board, physically shakes his fist at the changing numbers, and screams, "Doesn't anyone want to make a guaranteed profit?"
Which is just so perfectly ignorant.
It gets worse. It turns out John didn't even understand the basic structural rules of the contract he traded. August pork bellies weren't even deliverable against the February contract. He had constructed a trade that was mechanically impossible to win.
So Marcus finally fires him, I assume.
Yes, he fires him. And John's reaction is deeply bizarre. He tells Marcus he is making a huge mistake. John confidently declares he is going to move to Bermuda, wash dishes to build a new trading stake, and then become a millionaire.
Washing dishes in Bermuda.
Yeah, he specifically outlines a plan to wash dishes in Bermuda as his path to financial dominance.
The absolute delusion. But the fascinating thing about Marcus is his resilience. He doesn't quit after that disaster. He starts intensely studying the markets himself. And by the summer of 1970, he actually strings together some wins, turning a small stake into $30,000.
Which is a huge comeback.
It is, but he starts to feel invincible. And that unchecked hubris sets the stage for the terrifying 1971 corn blight disaster.
Oh man, the corn blight. Tell me about this.
So a rumor was aggressively circulating through the trading pits that this severe blight, which had devastated the corn crop the previous year, had survived the winter freeze. And the rumor was that it was going to mutate and destroy the upcoming crop all over again. Marcus, fully buying into the narrative, decides to go all in.
And when we say all in, we mean maximum leverage, right?
Exactly. He takes his entire $30,000. He borrows another $20,000 from his mother, which just adds an excruciating layer of personal pressure, and bets the entire $50,000 on the corn blight. He buys the absolute maximum number of grain contracts his margin limit will allow.
Wow, so if the market sneezes, he is dead.
Right. And then reality hits. Marcus is watching the board on Monday morning, and the Wall Street Journal publishes an article with a completely devastating headline. It read, "More blight on the floor of the Chicago Board of Trade than in Midwest cornfields."
So it was fake.
The mutated blight was a complete myth. It was just a phantom narrative created by the market.
Oh man, so the market opens sharply lower. Marcus is standing there, watching his net worth literally bleed out. He knows objectively he should sell immediately and cut his losses, but he freezes.
The psychology of loss paralysis just takes over.
Exactly. He starts bargaining with the market, hoping it will just bounce back a few ticks so he can get out with dignity. But the market doesn't care about his dignity. The trapdoor opens and the market locks limit down.
We really need to pause and understand the mechanics of a limit down scenario, because it is the absolute ultimate nightmare in futures.
Yeah, explain how that works.
Exchanges have rules setting maximum daily price limits to prevent total free fall. When sheer panic hits and the true value of the commodity plummets below that allowable daily limit, trading simply ceases. The market freezes.
So you can't even sell if you want to.
No. There is an ocean of desperate sellers screaming to get out and absolutely zero buyers willing to step in at that restricted price. You are essentially trapped in a burning building. You know exactly where the exit is, but the exchange has welded the door shut.
The physical sensation of that must be nauseating. He goes home, knowing his money and his mother's money is evaporating into thin air, and he is legally prohibited from hitting the sell button.
He had to suffer through the entire night.
Yeah. And the next morning, the market opens lower again, and he finally manages to liquidate. He loses his entire $30,000 and $12,000 of his mom's money. It's just a catastrophic failure of risk management. He bet his entire existence on an unverified rumor.
But this total annihilation is the crucible that forces his ultimate transformation. He takes a menial research job just to stay near the markets, slowly rebuilds his stake, and then he meets Ed Seykota.
Ed Seikota's legend.
Oh, yeah. Seikota was an MIT graduate and an absolute pioneer in early computerized trend following. What Seikota modeled for Marcus was something Marcus desperately lacked up to that point: extreme, emotionless discipline.
Marcus tells this incredible story of watching Ed manage a short position on silver. Silver was just bleeding down, maybe a half penny a day, and everyone else in the market was fiercely bullish. They were reading the news, screaming that silver was fundamentally too cheap and a massive bounce was imminent.
Right, the narrative was deafening.
Completely deafening. But Ed just sat there, calmly holding his short position. When asked why, Ed's philosophy was brilliantly simple. He said, "The trend is down, and I'm going to stay short until the trend actually changes."
He just completely ignored the crowd's narrative.
Exactly. He strictly followed the mathematical reality of price, ignoring all the noise.
And that is the ultimate synthesis of everything Schwager and Marcus had to learn through failure. You simply cannot impose your intellectual will on the market. You cannot let your ego dictate that your fundamental research makes you smarter than the collective price action.
You have to adapt to the reality in front of you.
Right. You must strictly define your risk before you enter, instantly admit when your timing is wrong, and have the cold patience to ride the actual trend, not the trend you intellectually wish was happening.
So what does this all mean? We have covered immense ground today. We started by challenging the academic dogma that beating the market is a statistical impossibility, proving that human emotion shatters the illusion of perfect efficiency.
Right, the 10 to the negative 160th power odds.
Yeah. And then we explored the structural battlefield of the futures market, where the absence of an uptick rule and the sheer power of margin deposits create a highly leveraged, double-edged sword. We watched Jack Schwager hide in a basement using weather codes, only to get steamrolled by a 99-cent cotton market because he completely ignored timing.
And we watched Michael Marcus graduate from paying an advisor in potato chips to freezing in the psychological terror of a limit down panic.
Exactly.
Yeah.
All before finally learning the icy, robotic discipline of Ed Seikota's trend following.
If there's one core insight for you to extract from the market wizards, it is that long-term success, whether you are trading millions in highly leveraged futures or just attempting to navigate the complexities and risks of your own career, is rarely about having access to perfect, undiscovered information.
It's about something else entirely.
True outperformance comes down to how you manage your own internal psychology when the information turns against you, and possessing the rigid discipline to cut your losses before they become fatal.
Which brings us right back to where we started. Think about that marathon analogy. Anyone can run 26 miles if they just grit their teeth, suffer, and rely on sheer brute force effort.
But that won't win the race.
Right. To run an elite time, to consistently separate yourself from the massive crowd of participants, requires a specific, innate talent and an inner radar for your own capabilities. So look closely at your own daily pursuits. Are you currently trying to win your race on stubborn brute force effort alone? Or have you done the difficult introspective work to find the specific arena where your unique psychological makeup gives you a definitive unfair advantage over the rest of the pack? Something to think about.